There's been a lot of buzz recently about SCHD, a dividend-focused ETF among top investing channels. But what makes it so special? Does its dividend strategy justify the hype? How does it compare to the popular S&P 500 index funds like VOO? And most importantly, is SCHD the right choice for every investor, or does it have drawbacks to consider? In this video, I will dive deep into SCHD, answering these questions and more. By the end, you will know whether SCHD deserves a place in your portfolio as a long-term forever holding ETF. The reason I invest in my forever holding ETFs goes beyond obvious indicators like annual returns and dividend payouts. I also focus on the fundamental forces driving these indexes for consistent performance, including the US resilient consumer-centric economy, its pro-business policies, and its culture of innovation. By investing in a basket of the best performing companies in the world, I'm betting on the strength of this country. In times of turbulence, understanding the fundamentals of investing and maintaining a long-term perspective allows me to sleep well night after night, confident that these ETF positions will continue to perform over time. When investigating SCHD, I make sure to keep the big picture in mind. I've identified 5 key considerations for an ETF to qualify as a forever holding. These are: number 1, a solid foundational thesis that supports the ETF or the underlying index it tracks. Number 2, passively managed to mirror a US market index. Number 3, a proven track record with an average annual return of 10% or higher over the past 10 years. Number 4, it complements the other ETFs in my portfolio. Lastly, it pays dividends that at least offset management expenses. Let's see if SCHD checks these boxes. First, what exactly is SCHD? SCHD is an exchange-traded fund offered by Schwab designed to track the Dow Jones US Dividend 100 Index. According to its prospectus, the index selects the top 100 US companies based on dividend yields. Each company must have sustained at least 10 consecutive years of dividend payouts and have a minimum market cap of $500 million. Additionally, there are 4 other stringent qualifying factors: cash flow to total debt, return on equity, dividend yields, and the 5-year dividend growth rate. Let's examine each of these. Cash flow to total debt measures a company's financial health. A higher ratio indicates not only a greater ability to cover debt obligations, but also more flexibility in how the company uses its cash. The cash can be reinvested to grow the business, distributed to shareholders as dividends, or used to pay down, even acquire more debt. This ratio serves as an indicator of the company's overall financial strength. Return on equity measures how well a company generates profit from its shareholders' equity, or net assets. Simply put, it shows how efficiently a company can generate profits using its assets. A higher ROE compared to its peers indicates that a company is better utilizing its assets and resources to create income. This is a key indicator of operational performance. Dividend yield is the amount of dividend a company pays per share, expressed as a percentage of the share price. For example, if a company pays a dividend yield of 3%, it means the company pays $3 annually for each $100 share. 5-year dividend growth rate shows the average annual rate of increase in dividend payments over the past 5 years. This indicates the company's ability to grow its dividend payout year after year. To clarify, this is not the growth rate of the dividend yield itself. For example, if a company's stock price rises, the dividend payout may increase proportionally while maintaining the same dividend yield. To summarize, looking at dividend yield alone is not a reliable indicator of a company's performance. A company may choose to distribute a large portion of its earnings to investors, which can lead to a higher dividend yield. However, this approach may hinder the company's ability to reinvest in growth. Additionally, a high dividend yield can result from a falling stock price, signaling a potential trouble ahead. By combining, however, these 4 selection criteria, SCHD ensures that its holding companies are financially strong, perform well operationally, and have the ability to grow their dividend consistently. I like this selection criteria because they form a solid foundation for the ETF, supporting its potential as a forever holding. This checks the first box of my forever holding ETF strategy. Let's examine SCHD's other characteristics. SCHD is passively managed and has an expense ratio of 0.06%. This is higher than VOO's 0.03%. However, its dividend yield is 3.64%, which is 3 times that of VOO's 1.22%. As you can see, SCHD's top holdings include companies such as Cisco, BlackRock, Home Depot, Bristol-Myers, and Chevron, which span sectors like financials, healthcare, technology, consumer discretionary, and energy. Each company makes up less than 5% of total holdings. About 85% of SCHD's holdings are in large or mid-cap companies, with an underweight in technology. In fact, the overlap between SCHD and the growth-focused ETF QQQM is only 6%. Overall, SCHD provides a good diversification contribution to complement my existing ETFs. SCHD has generated an annual average total return of 13.3% since its inception in 2011, slightly lagging behind VOO's 14.7% during the same period. However, this is still very impressive, especially considering SCHD doesn't include any of the mega-cap technology companies that make up a large portion of VOO. Additionally, SCHD is less volatile than the benchmark, with a beta value below 1. It's also worth noting that SCHD's trailing PE ratio is 18, significantly lower than VOO's 27. The companies in SCHD are considered value stocks. Given its lower volatility and undervaluation compared to other benchmark index funds, SCHD can serve as a defensive play in an asset allocation strategy, especially now that markets have reached historical highs. SCHD is an open-ended fund, meaning dividends can be automatically reinvested. Its holdings are rebalanced annually and reevaluated according to its qualification criteria. Based on the facts mentioned so far, SCHD checks all the boxes for inclusion in my forever holding ETF portfolio. I already have VOO, which tracks the broader growing economy, and QQQM, which plays offense by riding the wave of AI transformation. Now SCHD plays defense, focusing on financially strong, dividend-paying companies. This is my three-pronged ETF portfolio strategy, designed to enhance both growth and stability in the long term. Some may argue that investing solely in QQQM and SCHD provides a sufficient balance between offense and defense. However, as shown in the diagram, a portfolio without VOO misses a significant portion of the S&P 500 companies. Therefore, I consider VOO the first building block for anyone's core ETF portfolio, followed by other funds to complement it. My three-pronged ETF allocation strategy may not align with your needs because our financial goals are different. As I mentioned in my other video on asset allocation, I am now retired and seeking stability in my portfolio, using dividend payouts for living expenses. This may not be the case for you. Please note that the reason SCHD has underperformed VOO in the long term is that SCHD's holdings allocate a higher portion of earnings to pay investors. In contrast, I believe the best performing companies are reinvesting their earnings to fuel business growth. Additionally, higher dividend yields come with higher tax liability for investors. If you don't rely on dividends for income, the combination of VOO and QQQM may be a better fit for your portfolio. Thank you for watching. Please subscribe to my channel.